There are 9 invisible banking tiers, and almost nobody realizes they are climbing them. At each level, bank quietly change how they treat you, even if you never notice it. Let's start with the level 1. Level 1, below 0. The system stop asking what happened and start asking which category you fell into instantly before you have even had a chance to explain anything to anyone. Whether you are $2 negative or $200 negative, the fee attached is usually identical because most overdraft systems build the category, not the size of the gap. A second charge landing while you're still negative often triggers a second full penalty. Same hole, two separate fines. That's the part worth sitting with. Overdraft fees are structurally flat, not proportional. A $6 mistake and a $600 mistakes frequently cost the exact same $34 to $35 penalty. The bank isn't measuring the size of your problem, it's measuring whether you crossed a line at all. There's a second layer to this tier that rarely gets talked about: free stacking order. Some banks process the largest transaction of the day first, specifically because it's more likely to trigger an overdraft, which then causes every smaller transaction behind it to also incur its own fee. It's not universal, and several banks have phased it out after lawsuits, but it's worth knowing it exists. Because the auto transaction post in can be the actual difference between one fee and four. And here's something almost nobody checks. Some banks offer a small overdraft cushion, sometimes $5 or $10, where no fee applies at all if you cross back within that buffer. It's rarely advertised, it's usually buried 3 minutes deep in the account terms. And here's what's interesting. Most banks in the US UK offer free low balance text alert that aren't switched on by default because the bank has no financial incentive to help you dodge the fee. And the good news, it takes about 90 seconds in your app settings to close this door for good. And that tiny change can save you from an expensive mistake. Level 2, the invisible tax. Once you are above zero, the penalties don't disappear, they just get quieter. Most checking accounts with balance below roughly $1,500 to $2,500 come with a monthly maintenance fee. It's the price of not having enough money to avoid paying the price of not having enough money. It's one of the few fees in modern banking that designed specifically to affect people with lower balances. Around this level, you also start to seeing offers for secure credit cards. Here's how they work. You put down $200 or $300 of your own money as a security deposit. The bank then gives you a credit card with the same amount as your credit limit. If you carry a balance, you could end up paying 20% or more in interest even though the original deposit is still your money. One thing that's worth knowing, many credit unions offer something called a credit builder loan instead. It helps build your credit in a smaller way, often at much lower cost. The catch? It's rarely advertised next to the credit card offers. In many cases, you have to ask for it by name. But there's another cost at this level that never appears on a bank statement. Every declined transaction, every automatic payment that fails, every time you check your balance before buying groceries, each one chips away at your attention. People with higher balances rarely have to think about those moments. There is no dollar amount attached to that mental burden. But over months and years, it adds up and it's exhausting. Level 3, the pattern tier, somewhere around a steady 5-figure balance with a reliable paychecking landing every couple of weeks, something changes. Not because of the amount sitting in your account, but because of the pattern behind it. To a bank, a consistent direct deposit is one of the strongest signals of a valuable customer. It tells them your income is stable. It gives them confidence that your relationship with the bank could last for years, bringing future fees, interest, and other financial products along the way. Almost without noticing, things start getting easier. Monthly maintenance fees disappear. Real unsecured credit card offers begin showing up. Sometimes before you even realize, the bank is treating you differently. Here's something most people don't know. The offers you receive aren't based on your credit score alone. Banks also look at your balance history, how consistently money comes in, and how long you have been a customer. That's why two people with the exact same credit score can receive completely different offers from different banks. And here's where the opportunity is. This is one of the best times to shop around. You are valuable enough that bank actually want your business. But you're not yet so tied to one institution that switching feels impossible. Sometimes a 5-minute phone call asking another bank to match or beat your current offer is all it takes to get a better deal. Most people never make that call. Not because it wouldn't work, but because no one tells them this window exists. And by the time they think about it, they are already settled into the bank they have been using for years. Level 4, the qualifying tier. This is one of the least talk about tiers. Not because nothing changes, but because almost everything changes behind the scenes. With a balance of around $50,000, combined with a stable financial pattern, many people begin crossing internal qualification thresholds without even realizing it. Mortgage pre approval letters, higher unsecured credit limits, sometimes even lower rates on auto loans that were never publicly advertised. The bank isn't making these offers because you asked. It makes them because your financial profile now clears an internal underwriting threshold automatically and quietly in the background. This is also the point where monthly account fees become largely irrelevant. Not because you're wealthy, but because the bank now earns far more from your overall relationship than it costs to maintain your account. There is something else happening here that most people never see. Your banking history can influence more than just your bank. In some situations, lenders and insurers may consider banking related signals such as the age of your account or a history of overdrafts as a part of broader risk assessments alongside many other factors. Exactly what data is used depends on the institution, the product, and the local regulations. In other words, the financial story your bank has been collecting for years doesn't always stay inside the bank. It can quietly shape opportunities across the rest of your financial life, often long after you open the account. Level 5, the relationship tier. Once you combine relationship balance reaches roughly around $75,000 to $100,000, something stubble changes. The bank stops seeing you as just another account and starts seeing you as a relationship worth keeping. You're often assigned a dedicated banker or relationship manager depending on the institution. Because keeping a customer like you is usually less expensive than finding several new customers who generate the same revenue. That shift changes more than just who answers your emails. Fees that once felt non negotiable suddenly become negotiable. Not because the rules changed overnight, but because the person you are dealing with may now have the authority to waive certain fees without sending your request through multiple layers of approval. A $30 fee that once meant waiting on hold and explaining your situation to three different people can sometimes disappear with a same day email. Here's what's really happening behind the scenes. Most banks give employees some level of discretion when it comes to fee waivers. The difference is that frontline staff at lower account tiers may have less authority or less flexibility to use it. Here's a tip you can use today, no matter how much money you have. If you're asking a bank to remove a fee, don't just complain, ask for a one time courtesy waiver. That specific phrase often routes your request through a different internal process than a general complaint. It does not work every time, but it costs nothing to ask. And it's one of the few strategies on the list that can help you at almost any level of the ladder. Level 6, the advisory tier. Once your combined assets reach roughly $500,000, the conversation starts to change, not from solving problems, but from planning for the future. Instead of talking about overdraft fees or credit limits, you are talking about the next 10, 20, or even 30 years. In many cases, a financial advisor or a relationship manager reaches you out before you ever think to ask for one. The focus shifts from how do we fix this to what are you trying to build. Products are no longer presented one by one. Instead, they are packed into a broader financial strategy, retirement account, tax efficient investment options, insurance, estate plannings. Each piece is presented as a part of a larger plan rather than a standalone product. This is also where the cost of financial advice starts looking very different. At lower wealth levels, guidance is often limited to online calculators, educational resources, or general recommendations. At this tier, the advice becomes far more personalized, and it may even appear to be free, but in many cases, it isn't. Rather than charging an upfront consulting fee, banks and wealth management firms compensate it through ongoing asset management fees or commissions built into certain products and services. That doesn't automatically make the advice bad, far from it, but it's always worth asking a simple question. How are you compensated for this recommendation? And there's one more question that's just as important. Are you legally required to act in my best interest? Or are you only required to recommend something that's considered suitable? Those two standards sound almost identical. They are not. One places your interest first, the other simply requires the recommendation to be appropriate. It's a simple distinction on a paper, but over the courses of decades, it can make a very real difference to your financial future. Level 7, the private banking tier. At this level, the bank isn't just managing your money anymore, it's managing the risk of losing you. Private banking clients often work with a dedicated banker who serves a much smaller group of clients than a typical branch of employee. That means every relationship matters. not just to the bank, but often to the banker personally. The conversation changes again. Interest rates and lending terms are no longer limited to whatever appears on a public rate sheet. Depending on the institution and the situation, they are often negotiated individually. If a comparing bank makes you a better offer, there is a good chance your banker will try to match it or even beat it to keep your business. Not out of generosity, but because retaining long term clients is one of the most valuable parts of private banking. Service changes just as dramatically. A wire transfer problem that might require multiple phone calls at a standard account level can often be handled through a single call to your dedicated banker. You spend less time navigating the system because the system is increasingly designed around you. Even the smallest details begins to feel different. Your birthday is remembered, your preferences are already on file, emails arrive addressed correctly, conversations pick up where the last one ended. It feels personal. In many ways it is, but it's also strategic. Personalized service isn't just good hospitality, it's one of the most effective ways banks retain their highest value clients. At this level, exceptional service isn't simply a perk, it's a part of a business model. Level 8, the institutional tier. By the time you reach this level, the relationship changes again. Many financial products are no longer something you simply apply for. Instead, they are often tailored around your specific financial situation. Rather than choosing from a list of standard options, the conversation becomes a negotiation. Large lending arrangements, investment strategies, specialized financing, they are increasingly customized to fit the client, not the other way around. Timelines can change too. Requests that might take weeks through a standard process are sometimes handled much faster. Not because the rules are different, but because dedicated teams are assigned to high value clients, allowing decisions and paperwork to move more efficiently. There's another difference that almost invisible from the outside. At this level, there often isn't a public brochure or a standard rate sheet. Many of the terms are discussed privately and negotiated individually. The larger and more complex the relationship becomes, the more customized the agreements tend to be. This is also where certain private investment opportunities begin to appear. These aren't secret investments, they are simply opportunities that are available only to investors who meet specific wealth, regulatory, or participation requirements. Most people never see them because they were never intended for the general public in the first place. Even the meetings begin to look different. They are less likely to happen at a neighborhood branch. They may take place in private offices or conference rooms designed for wealth management and institutional clients. The setting itself sends a quiet message. At this level, discretion, privacy, and personalization become just as valuable as the financial products themselves. Level 9, the influence tier. At the very top of the ladder, the relationship changes one final time. The bank isn't just serving the client anymore. In some cases, it's listening to them. Clients at this level may be invited to private advisory events, market discussions, or strategic conversations, not because they are bankers, but because their experience, business interest, and investment activity can offer valuable perspective. Losing a relationship of this size isn't just another closed account, it's a meaningful loss for the institution, one that measured carefully and taken seriously. That doesn't mean every request is automatically approved. It doesn't. But when possible, banks often look for ways to restructure a request, propose alternatives, or find solutions that preserve the relationship. At this level, the value of long term partnership shapes almost every conversation. And when you step back, you realize something. Every tier on this ladder followed the same rule. The bank was never being unusually kind. And it was never being unusually cruel. It was making the same calculation over and over again. What does this relationship cost to lose? And what does it cost to keep? As the value of relationship changed, so did the service. The flexibility, the attention, the opportunities, the warmth was never random. It was tied to economics, priced tier by tier, from the very bottom of the ladder to the very top. Before we wrap up, here's the part that actually worth remembering. Because understanding this ladder only matters if it changes what you do next. No matter which level you are on today, these 3 steps can make real difference. Number 1, turn on low balance alerts today, not someday. It takes about 90 seconds and it can prevent the exact chain of events that opened this video. Second, If you ever been charged a bank fee you think was unfair, call and ask for one-time courtesy waiver. It won't work every time, but it costs nothing to ask. Number third, if your balance and direct deposit have been stable for at least 6 months, don't assume your current bank is giving you the best deal. Call another bank and ask if they can match or beat your current rates or account benefits. This is often the point where banks are most willing to compete for your business. And that's the entire banking ladder. From your first dollar to private banking, every level changes how the system responds to you. Not because your character changed, but because your financial profile did. Once you understand where those invisible lines are, you can make smarter decisions and move up the ladder deliberately instead of discovering each tier the expensive way. And that's the banking ladder from level 1 to level 9.